The one thing that can bring this market to a grinding halt would be a hot CPI print on the Wednesday session. And there are compelling arguments for both sides, be it hot or be it cold. But that's it. The technicals here look absolutely fantastic. Outside of the one minor risk-off data point, which as we know is continued strength in utilities, everything's firing on all cylinders in the upward direction. So, let's build a game plan to tackle the week ahead. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe for 100K by the end of May, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, solid green-bodied bar with hardly any upper wick to really read into. Of course, the buyers were able to achieve a very strong close near the highs of the weekly range, so structurally buyers are in control. Notice that last week we had a gap up, so on the bar-to-bar count, we actually have a massive higher low outside of and above the previous week's range, which inherently means that we also have a higher high. So buyers go 2 for 2 on the weekly trend count. It's bulls on parade here. The only thing we really need to take away is that the trend is up. We have lows, higher lows, and we're basically trading right back into equal highs here at the all-time high. We're just a little bit shy, but remember that the major risk on the weekly chart was looking for a possible lower high underneath this 512.50 zone. The one compelling evidence here was the volume profile on the weekly. If we recall, this was a high volume node right from around in here. And the fact that we've broken above that really prevented the weekly chart from drifting into a downtrend. And now we can actually use this as a potential area of support if there is a stronger pullback. So no need for anchored VWAPs, no need for Fibonacci's. Obviously, we're sitting very close to the highest high, the all-time high. It's buyers in control on the higher time frame weekly. If we take a look at the daily time frame chart here, the first thing we'll do is evaluate this week's expected move. It's this box right around in here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 527.68, implying a higher high and a brand new all-time high as well. That's bullish. If we're contained by the lower bound, the number is 514 on the money. That's a massive higher low. It's also loosely confluenced with that weekly line in the sand, the gap fill reversal. The daily 50 SMA is going to meet us there as well. And once again, this area is between about 512.50 and 514 as we head into the week. This is a huge opportunity for a higher low. So the expected move does strike me as being bullish in the context of this trend. The trend, as we know, off of the lows is lows, higher lows, higher lows. We have not fallen into an hourly downtrend outside of this as the last major pullback. So this was not an hourly downtrend. This was not an hourly downtrend. And of course, we're sitting on the highest high in the trend count. We had highs, higher highs, higher highs, higher highs, and higher highs on the Friday session. So of course, if the daily chart were to pull back, we're still in an uptrend. We're still thinking about daily higher lows. The ideal place to find one would be here over that weekly line in the sand, lower edge of the weekly expected move, daily 50 SMA. Once again, the number is at 512.50. However, if we put our thinking caps on, let's just say that CPI is the hottest read we've seen in a very long time, and the market breaks down through the weekly line in the sand. Oh my goodness, it's the end of the world. No, it is not. We can still technically find a daily higher low from here to here on a gap fill reversal from the Friday momentum gap up from 2 weeks ago at 505.75. That's the gap closure to that previous Thursday high, correct? Now, don't get me wrong. That's not pretty, and of course it comes with its own array of threats, perhaps a lower high under the weekly line in the sand, but we'll get to that when we get to it. The main idea is that the daily uptrend is very much so intact and has a clear opportunity to remain intact with multiple opportunities for a higher low. Let's think about who's in control of this daily time frame chart. If we just zoom in here a little bit further, I really want to focus on some of these interactions. It's a momentum buyer's market. I mean, gap and go here, a little bit of a gap close, about 50%, but on that Friday session, we still closed near the high of day. Monday morning, we opened on a gap up and we did not look back. Tuesday's a gap up. We went for a gap fill reversal. Where did we close on Tuesday? Still outside of the Monday range. As we described in the Wednesday midweek midweek market update on Wednesday, the sellers actually achieved a gap down. So in theory, if there were ever a time for a pullback to emerge, perhaps a gap fill reversal keeping us underneath Tuesday's low could have gave us a gap close to the downside, tested the daily 50 SMA, the weekly line in the sand. It simply did not take place. Where did we close on Wednesday? Back inside of the Tuesday range. Thursday speaks for itself, closes dead on the highs of the session. And on Friday, would I consider this an exhaustion gap up? The answer is absolutely not. Sure, we closed the gap to the downside. We looked into the Thursday range, but again, where did we close that Friday session? Outside of the Thursday range to the upside, still respectful of this previous structure in the past as well, well above 519.50. So this is a momentum buyer's market, and clearly the buyers are in control. We're sitting on the highest high. We can afford a higher low pullback, and the key line in the sand on the daily chart at least is really looking for that 512.50, but we do have some leeway into this gap down here if, let's say, CPI goes incredibly wrong and we get a very, very hot print for something like a 2 sigma move to the downside. On the daily time frame chart, we've identified that momentum buyers are in control. So why are we talking about pullbacks? That's a pretty good question. If we are going to get continuation from these momentum buyers, I would love to see consolidation in here inside the Friday range, breaks over that Friday high, basically continue into all-time highs and blue sky territories beyond that. If we pull back, do the dance in here, you could still find a higher low here at 515.75. On the daily time frame chart, there are so many opportunities for the buyers to remain in control. And based on all of the evidence I can see in the reversal off of these lows, this is a buyer's market as of right now. Let's drop it on down to the hourly time frame chart and get a little bit more granular and start talking about some of the pathing and some of the more intricate trend changes that possibly can sort of occur here as trades. If we're thinking about the Friday low from 2 weeks ago, you'll notice that the market continues to march in the upward direction. I specifically want to hone in on that Wednesday session to once again illustrate the failure of the sellers here. Technically speaking, you'll notice there was an hourly inverted hammer, the second hourly bar of the Wednesday session. So did the sellers try to make something happen there? It would appear so. They did offer a little bit of a pullback, but once again, if we're thinking about the trend count, we have lows and higher lows. Let's think to ourselves, what would stronger sellers have done if this was truly the beginnings of an hourly trend reversal in the downward direction? They would have at least offered the equal low down here, and it simply didn't take place into the end of Wednesday's session. We did get that higher low, and the rest is history, moving in the upward direction. Another classic implication here is just when previous resistance then acts as support, that's totally a buyer's market, right? So as we're looking forward to the coming week's worth of trade, any consolidation inside of this Friday range is neutral technically, as in trades may not unfold in that area, but it's bullish consolidation in terms of location. If we're looking for a move in the upward direction, ideally the break and higher low is over 522.75, and you can set up risk reward that perhaps looks something like this in the upward direction for an initial at least 2-to-1, and then aim to balloon that into a 3, 4, 5-to-1 as and if markets continue into all-time highs, blue sky territories. If this is going to offer the beginning stages of a trend reversal, let's think about this, right? Maybe, just maybe, the market offers us a lower high double top with the intraday lower high on the Friday session. Where's your neckline? It's Friday's low of day, right? So if you're a seller, what you would like to see is a pullback emerge based on this sort of idea in here. Now, your risk reward may ultimately look something like this in the downward direction, certainly worth taking a crack at, but based on the identification of momentum buyers being in control here, I would be trimming and taking profits at almost every single downside target we have on the screen. So very faintly, we have 517.50, 515.75, and if we go beyond that, yes, it is the daily line in the sand, the weekly line in the sand there at 512.50. Now, when we get down here, put your thinking cap on, and you should be putting your thinking cap on at every single one of these areas of support. The major ones would be here at 515.75, thinking about reversals for back higher, inverted head and shoulders, and the other major one would be down here, right? Double bottom, inverted head and shoulders, very simply an hourly hammer candle, a daily hammer candle even down here at 512.50, respectful of the 50 SMA, the gap fill reversal, the previous weekly low. All of this stuff is top of mind, and I would prefer to be a pullback buyer than a seller who's really looking for this market to take a nosedive. Doesn't seem like it's in the cards based on the activity we've seen. Now, What's the caveat here? Of course, it's that CPI print. If CPI comes in hotter than the expectations, if it's an oh my goodness, inflation is resurging again, then yeah, the market's not going to like that, especially noting that last Thursday, the initial jobless claims didn't really look that good, edging up closer to that 230,000-ish, which is uncomfortable compared to the flat 205, 210,000 we've been used to recently. So anyways, that's my take on the hourly time frame chart here. As we start looking at, let's look at some supporting evidence on the hourly first, like our intraday anchored view apps. You'll notice that we're above the entire cluster, right? And what do we see here? Anchored view app here, anchored view app here, anchored view app here. So once again, are we overstaying our welcome on the short side? Probably not, as we're getting confluence out of almost every single major level that we've described so far if a pullback emerges in the first place. And once again, I want to be very clear that you really need to see that lower high underneath 519.50 before this as a short trade really starts to emerge, right? And maybe it balloons into something greater and you get that daily pullback into the line in the sand. But for now, above all of the anchored view apps. If we come in here on the hourly chart with our Fibonacci's from the low of the move to the tippity top of the move, where is the 38.2? You'll notice it's a loosely confluence with that weekly line in the sand reinforcing 512.50 as a key and major area of support. If we come in from the Monday session, the gap up, right? That's a weekly gap up to the high of the Friday session. The 38.2 is the neckline of that possible, it's not guaranteed, it's not on the table yet, double top here on the hourly. That number, once again, is at 519.50. Speaking of double tops, before we take a look at the market internals, I want to talk about this as well because I can guarantee some folks are going to start talking about it on social media or whatnot. Hey, look, it's a double top. No, it's not. Things are only a double top when you can break underneath the neckline and offer some sort of lower low to cause a trend reversal. So I did want to include that in some of the weekly analysis here for the Saturday update video. Let's bring this back down to the daily. In the meantime, we'll take a look at the market internals. If you're not familiar with the screen, check out the video tutorial in the top right-hand corner. If we look at the breadth of the week in terms of the volume flows, stronger inflows on the market, you can clearly see that we've closed positive cumulative volume on the week. Not quite substantial. We're typically looking for 600 million. 405 million was the end of week number. It's based on some of the flatter reads that you saw in here, but still, it's not like we have stronger sellers stepping up in this market, right? That's the main illustration. One of the things that does strike me as maybe somewhat concerning for, again, that double top hourly double top pullback to unfold is actually the index score from the Friday session, reaching down into somewhat negative territory here around negative 15. And as we know, this measures out of 25 data points as a total. So it's not like, oh my goodness, the world is ending, but it's probably worth respecting that the Friday afternoon, like sort of this consolidation down here, is more bearish than bullish. And, pair that with a bearish cumulative tick. Once again, the pullback doesn't quite seem, that's not unreasonable to me as a possible outcome into the early stages of this week's worth of trade. We'll finish up for the S&P 500 with the market profile, and this is right back in the bull's favor because you can clearly see that value areas are continuously marching in the upward direction. I would say that the biggest win this week for the buyers was the Thursday session finding value over the value from the Tuesday morning, right? So here's Tuesday's value, here is Thursday's value. The fact that this is progressive in the upward direction, once again, reinforces that buyers are in control. You'll also notice that on the Wednesday gap down, we only have A period single prints down here. What does that mean? It was a very emotional move in the upward direction, meaning that shorts, anybody who shorted this gap down likely got squeezed out of the market. And once again, momentum buyers appear to have the upper hand. If we take a look at the Friday session, value was lower in the overall session, but still higher than the Thursday session. So if we do get a pullback, is it detrimental for the longs? I would tend to think the answer is no. Be much more concerned if the value area was actually higher on that Friday session and we sort of like broke down underneath the value area and then the pullback started to emerge. That means that longs are trapped with even worse trade location. Because this is lower on Friday, it seems respectful to me that buyers were sort of waiting and looking for the gap fill reversal. Most people got involved sort of at or above near the Thursday highs instead of directly at the high of day from the Friday session. So longs don't really have, at least on a bar-to-bar count, the worst possible trade location here. Maybe there's a stop run underneath the lows, but again, it's not like longer-term shorts are like all of a sudden rethinking their positions here. These are just short-term momentum buyers, And again, location isn't horrible. So that is what I've got for you out of the ES and the market profile. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. And with that, we'll jump on over to the NASDAQ. So here we have it, the QQQs on a weekly time frame chart. What do we see in terms of candle structure and location? Just like the S&P 500 green-bodied bar, just a little bit of an upper wick. The noticeable difference here is that the weekly range was more compressed, and we'll see why on the daily chart in just a moment. Regardless, the buyers still closed near the highs of the weekly range, so buyers are in control. Location, just like the S&P 500, a weekly gap up for a higher low as well as a higher high. Buyers go 2 for 2 on the higher time frame chart. Just like the S&Ps, we don't need the Fibonacci's, we don't need the anchored view apps. The only thing we could sort of throw on here to support our claims is really understanding that we've recaptured the high volume node and the trend remains in the upward direction with lows, higher lows, higher lows, higher lows technically happening here, or you could really just view it through the lens of a breakdown and then the failed attempt for a lower high from the sellers underneath the bottom of the overhead supply. It's no longer overhead supply as we have a full week getting price acceptance inside of that range, and as we walk forward, you can see we're over the high volume node. So the name of the game here in that level, by the way, is 433.75. We'll see it on the daily chart in just a moment. We're looking for continued higher lows above and then equal high breakouts into blue sky territories, and concerns would only emerge when and if we break down underneath and offer a lower high to potentially change the weekly trend, because this isn't quite as cleanly an equal high like what we have in the S&P 500. Let's take it on down to the daily time frame chart here and see what's going on specifically in the QQQs as this loads up. A little bit of maintenance happening with Thinkorswim over the weekend, but I'm thrilled that they were able to get the platform back up and running. Here's that weekly line in the sand that we were just describing. Once again, the level is at 433.75. Before we go any further, let's firstly address this week's expected move. The upper bound is up here around 449.60 near the all-time high, also suggestive of a higher high in the current trend sequence, and the lower bound is at 434.61, suggesting a massive higher low. If you're not familiar with this study, check out the video tutorial in the top right-hand corner, all about expected moves. So the expected move does strike me as being bullish for both of those reasons, looking for a higher low or continuation into the all-time high. The trend here is certainly up. We have lows, higher lows, higher lows, massive gap up. Because this is much more of a balance, and this is the reason why the weekly range was a little bit more compressed, but because this is a daily balance, I would be willing to say that these are soft higher lows in here near the daily 50 SMA and this level at 437. So that is maybe a minor takeaway where if you're looking for a breakdown out of the market, and because also we don't have as cleanly an attempt towards equal all-time highs, if you're looking for a breakdown in the market, the loss of the NASDAQ 50 SMA and this level right here at 437 potentially jeopardizes the daily trend. I would really be more concerned about a situation that looks like this and then a breakdown into the gap below, which as we know is a little bit more dangerous. 432.65 closes down at 427.25. If we're underneath that weekly inflection point, not really looking as good for the QQQs. But let's talk about how we get there, because again, we're in a daily uptrend. However, Friday's session is a little bit different from the S&P 500 because of its interaction with this balance range right here. This really strikes me as an opportunity for a look above and fail, and therefore if the market does pull back to the bottom end of the range, I want to see buyers step up at that 437, not so much a flush through it to again threaten something that possibly looks like this. This is the most dangerous outcome this week. I would tend to think that more optimistic would be something that looks like this, consolidation and trying to resolve 442 in the upward direction. This higher low on the daily time frame chart over 442 is incredibly important because it represents a full retracement from the origin of the breakdown back here and finally price acceptance over the 4-day balance from Monday, Tuesday, Wednesday, Thursday of this previous week's worth of trade. Let's get a little bit more granular on the hourly time frame chart as to how exactly this might unfold. If we take a closer look over here, we know that the hourly trend is up. We have these lows, higher lows, higher lows, higher lows, and technically speaking, higher lows on the Friday session. Along the way, highs, highs, higher highs, higher highs, and Friday also did offer higher highs. The only trouble with this is that the hourly bar certainly does not at all suggest price acceptance above this flat top breakout point at 442. So if you were thinking of this as an ascending triangle into the Friday session, we got that gap up, really the lack of clean gap fill reversal and price acceptance over 442. I wouldn't go as far as to call it a fake break yet, but any sustained price activity underneath 442. If we get like a drive to the downside and a lower high intraday here, I would certainly be thinking about, again, if this is a balance range, look above and fail, right? The target is always the bottom end of the range, and that level, as we've already described, is at 437. So your pathing here out of the QQQ is really going to be more representative of this as a balance range and resolving the top end at 442 and the bottom end at 437. I do still think that momentum buyers are in control, and this is still exhibited by the failed gap down from the Wednesday session in the NQ, or the NASDAQ, at least the QQQ cash ETF. There's your gap down. There's still your inverted hammer in the second hourly bar. Notice your higher lows still remain over that Wednesday low of day, the opening print of that day's session. So still optimistic in this market. And once again, even if we go back to a daily time frame chart, this balance is really suggestive of acceptance. So this balance here is suggestive of acceptance in the larger overall 7-week balance. If the sellers were going to make something like, a sharp reaction away from the 50 SMA, the market wouldn't have really been doing the dance around this level. It would have more so rejected some of these prices. It would have tested more so this week the weekly line in the sand. It just simply didn't take place. Let's move along, or actually let's go back to the hourly chart. We're a little bit all over the place here on the NASDAQ, but I do want to show you the intraday anchored view apps, and once again, that we're above the entirety of the cluster. So if we can consecutively produce these higher lows, if this anchored view app can hold, I would still be optimistic for resolving that 442 in the upward direction. Your upper targets are going to be at 445.50, and then the all-time high up there around 449.31 technically is the number. If we take a look to the downside, right, this as a possible trade gets you here. So if you're trying to set up risk reward for a downside pullback to emerge out of the NASDAQ, then what you're looking for ultimately is something as follows. So sure, maybe there's a breakdown underneath Friday's low. This offers very similar to the S&P, some sort of double top. If you could spot, risk reward that maybe makes sense to get short around here with risk, in the upper box, reward down to the bottom end of the balance range, that's a good first step. But really, I'd be more so thinking about bullish acceptance in the 7-week balance in the range as we've just described. And the stronger short opportunity is only underneath this 437, right? If you could get a break and a lower high here, the better idea, the better opportunity for a short, in my view, is truly looking for the test of the weekly inflection point and setting up risk reward that looks like this. Now, as we know, just like the S&P 500, when and if we fully make that rotation into that 433.75, I would totally put my thinking cap on and say, all right, what's the opportunity for a double bottom reversal off of this? Can we spot an inverted head and shoulders? Can we spot a daily hammer candle off the retest of 433.75, then trade it back in the upward direction, aiming basically at these equal highs at the top of the balance at 442. What about a Fibonacci perspective? Anything interesting to share on the NASDAQ? Let's take a look from the bottom up to the top of the most recent move. The Friday high is way up there. The 38.2 also aligned with that weekly line in the sand, making sense from a support perspective. And if we come in, let's go from the Monday low up to the Friday high just to see where we're at. So anything that's really inside of this consolidation zone, you're sort of chopping around in no man's land. You can be my guest if you want to take trades inside of this area, but I'm not convinced that you would want to be an aggressive short in there. I think that the only opportunities for a short is avoiding the grinder in here and more so saying like, okay, can I get short here with very tight risk reward and see if that plays out? You'll probably have to sit through some chop and slop, but if it plays out, at least your location is decent. And then beyond that, as we've already described, right, being patient for something that looks like this is really the only other short opportunity that makes sense from a structural perspective. Just because we have not used risk reward boxes on the long side, let's finish the job and do something like this. If we were to get a more firm resolution that looks like this and then continuation of the all-time high, we're basically looking to align with ideas that ultimately do something along those lines. Let's move along to the market internals for the NASDAQ side of things. A little bit more of a mixed bag here with some stronger outflows on a few of the days, notably the Wednesday session as well as the Friday session. So again, is a pullback reasonable? Is a look above and fail reasonable based on the internals? When we add in this context, I think the answer is yes. Notice the advanced decline line was also fairly negative on both of these days, and the cumulative tick on Friday also not really helping the bull case. So the look above and fail to me is the primary outcome that I would sustain on the QQQs. Let's finish it up with a look at the market profile here, and this also supports the look above and fail in my view because this is basically the 4-day balance prior to the Friday session, right? And notice, excuse me, where the value area is after the failed attempt to clear the Tuesday high. Value area is completely contained back within the overall balance. So is it possible that you see that rotation to the downside? I think all of the evidence that I can see so far supports yes, but is that detrimental to the overall trend of the market? I think the answer to that question is no. And finally, the IWM Russell 2000 small caps on a weekly time frame chart. What do we see in terms of structure and location? Unfortunately, one of these things is not like the others. We've got much more of an inverted hammer printing on the weekly time frame chart. So in that upper wick, we know that the sellers stepped up and they were able to move prices back down towards the midpoint of the overall weekly range. Notice it's a green-bodied bar, so it's not like we tested the opening print. It's not like we made a new low, an expanded range in the downward direction. So it's not as bad as it could have been, but again, certainly a notable difference between this and the NASDAQ and the S&Ps. So with that said, structure's a little bit more mixed because we didn't make a new lower low on the bar itself or take out the open. I'd still say neutral there. If we're thinking about location on the bar-to-bar count, still a massive higher low as well as a higher high. The entirety of the weekly range was also above our weekly line in the sand at $200 down to $199. It's a little bit of a zone. As we know, we've been tracking this for quite some time. So the danger out of the IWM is that this is an inverted hammer, certainly suggests that a pullback might be imminent. If we can spot support over $200 down to $199 as that zone, we'll just refer to it as the inflection point from here on out. If we can find a higher low over the inflection point, then great, we're okay. And I wouldn't be overly concerned with, okay, here it comes, the head and shoulders pattern, right? Because we can also see if this does yield a sharper pullback and we're underneath the key inflection point, then all of a sudden this just looks like a head and shoulders, and then the breakdown of the neckline certainly offers a stronger, higher time frame reversal, in theory, back down to the bottom of this overall balance range down here. A couple of saving indications is the Fibonacci's coming in from the low up to the high. We're still over the 38.2. As we know, the head and shoulders doesn't really trigger until we're underneath the neckline. There is some wiggle room here to find that higher low over the inflection point, so it's not doom and gloom just yet, but it is worth pointing out that there are some notable weaknesses out of the IWM. If we come in from the top of the range down to the bottom of the drawdown, the inverted hammer is somewhat showing a rejection of the 61.8 Fibonacci, which, as we know, that kind of keeps us in no man's land, I suppose, in between that and the inflection point. But the market has stronger odds of a 100% retracement if it can firmly close bars over a 61.8, and it simply did not do that in last week's worth of trade. Let's drop it on down to a daily time. We'll go volume profile actually here out of the Russell, because this also is important. If we take a look, let's go auto zoom. There we go. This as a low volume void overhead does become interesting, right? If we can find more acceptance over that high, then this low volume void, I mean, not that it has to retrace in its entirety like 225, but it does help support a little bit more of a bullish thesis if we can stay above this as a high volume node, which, as we know, is support around that key inflection point, the zone 200 down to 199. Now let's go on down to a daily time frame chart and once again flip back over to the IWM. What do we see here out of this week's expected move? Certainly a little bit more neutral here, expecting a test of this area. We do have a gap fill reversal down towards the weekly inflection point. $200 was the gap up from the Friday session of last week, the Thursday high of 2 weeks ago, I should be saying more appropriately here. So any consolidation in this zone is exactly that, it's consolidation. On the daily chart, breakdowns and lower highs under 203, I'd be looking for that test of the weekly inflection point at $200 down to 199. Lower edge of the weekly expected move is there. When and if we get there, because the daily trend is sprouting, early signs of an uptrend, right? Lows, higher lows, opportunity for higher lows around the area, I would be on the lookout for that, right? If we're trying to remain constructive in the broad market, this is what you're looking for if you're bullish. Now, of course, if CPI comes in at a massive miss, remember that small caps are always more sensitive to fundamental data. So would I be surprised if CPI comes out, it's hot, and small caps are like down here trading 196.50s, perhaps even worse than that? Wouldn't strike me as a shocker if CPI is a big miss. If CPI comes in line, either consolidation here, possibility for higher low pullbacks around this zone are really much more so top of mind. If we can get a breakout in the upward direction over Friday's high, starts to walk this in the upward direction, 208.50 becomes a target, and 210.85. Let's drop it on down to the hourly time frame chart out of the IWM. Again, be my guest if you want to get sort of chopped around in this range over here. It was like a couple days up, gap down, couple days up. Friday takes it mostly all back. So, for the most part, I would tend to think that setting up longs off the bottom end of the range for something that looks like this makes sense risk reward wise, right? You could trade that as a possible long idea. If you're looking for the short, let's bring out the red crayon. You're probably waiting for the lower high under 203 to indicate the breakdown of the balance range. Then what's the target, right? You're looking to play for something that does this into the weekly inflection point. Once again, 200, as we all know, that's like your top watch out of the IWM. So that's your up and down around 203. Obviously, if there's a break to the upside, you're trying to set up risk reward. That would be a little bit more constructive in the upward direction. Let's just say that we get the move to, look something like this, something along these lines, risk reward wise for a breakout or continuation. It's of course tradable, but even if you're not someone who trades the IWM, I've been going on this rant for a while now. It's like any consolidation in here is helpful for your S&P 500, right? Small caps acting as a tailwind for the marketplace is certainly an idea worth, understanding to have more or less confidence in the S&P 500. So in this box, neutral for the S&P is breaking out is solid. Pullback in here is not the end of the world, so we'll use white for a little bit more neutrality, really looking for that daily reversal off of $200, the weekly line in the sand. The most detrimental outcome, as we know, is just the breakdown of the weekly line in the sand. So if something like this were to take place, and again, CPI might be the catalyst to do it, we'll change our tone, but we're simply not there yet. Let's bring out the Fibonacci's on the IWM hourly from the low up to the most recent Friday high. Notice that the 38.2 is loosely aligned with that weekly line in the sand zone. So, sort of adding into confluence near this area, thinking about support here instead of big new money shorts as we come into the zone. If we bring it in from, let's try from this low, obviously Monday, the entire week out of the IWM was more so consolidation. This isn't really all that helpful from the last major pivot low. Let's just check in on from the bottom of the weekly range to the top of the weekly range. Maybe we closed in the lower sort of Fibonacci zone down here, so it's a bearish bias. I wouldn't even say that, actually. I wouldn't say bearish bias down here for consolidation. There's no trend in this box. I would say maybe if you add in some context, it's bull flag consolidation, but there's no trend in the box. Location-wise, it's actually more advantageous for longs off of the bottom end of the range. And once again, only if we get the break and lower high underneath is it worth an attempt for maybe a quick scalp here. But really, the takeaway is that you would want to dial back long expectations in the S&Ps if the Russell is breaking underneath that 203 to close the weekly gap down here at 200. Anyways, enough talking about the small caps. I suppose we're not done yet, but we've got to take a look at the intraday anchored view apps. So more so consolidating around them. Once again, I think it reinforces the idea that if you're under 203, maybe this opens up in here. There's not much going on if you're just grinding around in the range. So take that at face value. Here are the market internals for the Russell side of things. The net volume flows on the week, pretty pitiful. Nothing major there. And again, you've got a little bit of upside, flat, downside, upside, back and forth consolidation. We saw that on the price chart itself. So this really shouldn't come as much of a shocker. Maybe the only bearish data point here is really just understanding that the cumulative tick on Friday was the most expressive from either side of the trade throughout the entire duration of the week. So, although location might be advantageous, Friday's cumulative build is showing you, sellers actually had a little bit more control at the exchange level on that Friday session. I think that the market profile is a great thing to end on here for our Russell 2000, simply because it shows us, right, that we made zero progress anywhere this week. Here's Friday's value area, here's Thursday's value area, here is the Wednesday, Tuesday, Monday, right? If you were to just make an average of the two, you did nothing all week, right? So small caps not really showing us much, and once again, sort of reasonable considering the dialing back of risk taking ahead of the CPI. As of right now, we do have a poor low on Friday's session, so the one tradable outcome here out of the Russell would be if we repair the Friday low, meaning that we sweep this and move into the bottom end of the range. So this is actually a decent thing. This will be a top watch for me early on in the week. So if you made it to this point in the video, let me know too that you're watching the Russell 2000 by putting R2K in the comment section down below. Not the Y2K, but R2K down below in the comments if you made it to this point. The repair of the poor low from Friday. So sweep this low, and if we find buyers at the bottom end of the weeks long balance range that we were just describing, so in the Russell futures, it's loosely around 2055 down to about 2050, which as we know is the futures inflection point, 2050 down here. If we find buyers down here after repairing the poor low, I would be looking for, that long back towards the top end of the range. And again, even if you only use this as an indication for the S&Ps, that's going to be massively helpful to understanding that, all right, watch out for the S&Ps to catch a bid if small caps are supporting after repairing the structure here off the bottom end of the range. Let's get into the supporting evidence now, beginning with the weekly performance of the S&P sectors here. Notice that utilities continue to lead in the upward direction, up 3.86%. As we know, they are a lightweight and D for defensive sector, which is a small concern as the market's making this advance back up towards all-time highs. Generally speaking, that's not going to be as sustainable as, let's say, tech or the semiconductors leading the market in the upward direction. However, speaking of tech and the semis, let's not ignore that SMH is still up about 1.8% on the week. Tech technically underperformed the S&P index itself, but it's still up over 1% on the week. It's not like we have a massive divergence and tech is down something like 2% and the market's trying to make a new all-time high. That would be much more of a concern, but it's simply not the case as of right now. Underneath utilities is financials, and financials, as we know, are a heavier weight risk-on style sector. So beautiful to see financials up 2.37% on the week. Just underneath, unfortunately, flipping back and forth here, is the consumer staples sector, XLP, up 2.06%. Again, as a leader, it's more of a defensive sector. It's certainly lightweight as well. So not nearly as lightweight and defensive as utilities, but still not great to have at the top of the list. Let's check in on the structural charts. Utilities continue to tear in the upward direction. There's not much to say about this chart. A pullback is fine. Certainly an opportunity for daily higher lows here over 70, weekly higher lows, even still daily higher lows up and over this breakout point. It was a 2-day high, then a 2-day low. I mean, this market structure out of utilities very thin in the upward direction, but it speaks to the strength. So is it a risk-off rotation still? I mean, at first glance and in isolation, it seems like yes, but we're also seeing some performance this week out of the tech side of things. So let's move into financials. A clean recapture of this inflection point right here at 41.20. Any higher low pullbacks are welcome over the neckline of this as a higher low double bottom. This is back into the risk-on category. This is looking really sharp out of financials. Next up, we've got consumer staples. The trend is clear. The inverted head and shoulders pie in the sky did break out. So once again, higher low pullbacks on the daily over 76.25 are fine. Technically, it's a little bit more of a risk-off rotation. However, upward pressure is upward pressure. Materials, really lightweight sector, but you are resolving the sloppy range in the upward direction. Once again, the idea would be either continuation is fine, upward pressure is upward pressure, or higher lows here are great. The only time we'll be more concerned is if we make a new swing low underneath 88.65. Doesn't look likely as of right now. XLV, healthcare sector, third heaviest weight sector by market cap, now underneath the XLF. What do we see? Inverted hammer on Friday, tried to recapture the daily 50 SMA. Still well underneath the overhead supply. So I have to be a little bit more neutral out of healthcare here. I would certainly be way more bullish on financials than I would be on healthcare. Notice we did break out of this. So I'm not going to deny the fact that you can still find a higher low here and you can start to be constructive. Remember, all trends have to start somewhere. But the weekly opportunity for a lower high here does strike me as a little bit more concerning. Now, as we just sort of balance the data points here and again, consider whether or not the market's firing on all cylinders, what else do we know about the healthcare sector? It's technically, although it's heavyweight, it's D for defensive, right? So to see this underperforming financials in terms of the market structure, it's not as worrisome. So I actually like that out of the XLV, in compared to the XLF. What do we see here out of the SMH? Big recapture of that 219.70, 75 area we've been describing. Again, any consolidation above is awesome because we've printed a higher high on the Friday session. Even a higher low that's technically underneath the inflection point here is still okay. Once again, the trend is emerging in the upward direction off of this reversal. Lows, higher lows, highs, higher highs on Friday. You could cleanly get a higher low over the gap. You could go gap fill reversal, higher low. The only issue is NVIDIA earnings, which are not yet this week, but the following week after that. So NVIDIA is on the horizon. I would say for this upcoming week would probably have more of a bullish than bearish bias out of this particular chart. Next up, industrials. What do we see here? Pressing into new all-time highs. Looks bullish to me. Next up, XLC. Communications resolving, that 80 mark in the upward direction with total bullish consolidation above. I think that's the exact comment we made in last weekend's update. Real estate, what do we see? Recapture of the neckline. So what's the premise here? Why is this worth paying attention to? Because real estate is obviously incredibly sensitive to interest rates. If CPI comes in hot, do not expect this to continue to perform in the upward direction. Is that the end of the world? The answer is no. Real estate's a very, very lightweight sector for the S&P 500 as an index. So the recapture is helpful, but it's not going to be the end of the world if we break down with rates moving higher, or the implied rate, right, moving higher because CPI is still hot. Jerome Powell is going to keep us higher for longer. We'll get to that stuff in just a moment. Finishing up the sectors, we've got the XLK. Strong recapture this week of the key inflection point. Remember that the XLK on the Friday session of last week, 2 weeks ago, right, did not recapture the inflection point, whereas the QQQ did. The fact that we are now above, the fact that we printed a higher high on Friday, does make me a little bit more optimistic out of the XLK as a sector. Ideally, we stay over the 203.90 mark, even if we do pull back, just like the SMH. Because we have a higher high, this higher low is still acceptable over 201.40 in my humble opinion. Next up, we've got the XLE, what's going on with energy. If this sets a lower high here, that is going to be bullish, I would imagine, because of what it implies for inflation. And again, we'll get to this stuff in just a moment. But if energy can cool off into the summer, if we avoid this massive breakout in energy. So remember, this is a monthly time frame chart that I just quickly flipped to, right? This was a huge ascending triangle. It's not fully dead in the water yet, but if this turns into a failed breakout and we move to the downside here and just chop around inside of the range, remember, that helps inflation over the summer months instead of exacerbating energy prices, transportation prices over the summer months when everybody is out and about doing things, right? So this would actually help the Fed if energy came in a little bit here from an inflation standpoint. Next up, XLY, let's bring it back on down to a daily time frame chart here. Let's take a look. Steps in the right direction, but we're not out of the woods, right? So over the neckline of the double top from over here, sloppy, choppy, can't quite resolve the 50 SMA. It's, day up, day down, day up, day down. Not in love with it. Seems like there is the threat to lose it again and move in the downward direction. So this to me is a small concern. I would put this in the concerning category instead of improving category. It's trying, but it's just not nearly as clean as something like the SMH or even the XLK at this point. Let's take a look at the ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. What do we see here? This is, I would say it's a good attempt to hold up over the neckline of what could be considered a double bottom. Ideally this week, it makes an advance over a downward sloping 50 SMA, and we start to see that thing flatten out. If that's the case, this falls back into the risk on category as of right now. Little bit more neutral with that double bottom formation. XLF looks good on the recapture of the still upward sloping 50 SMA. This is trying to remain positive for us. This offering a lower high is constructive because we know healthcare is defensive. This is not good, and as we just described in the structural chart, it's actually the only red name on the week, right? Consumer discretionary, it's hideous, and Tesla has a lot to do with that. Thank you, Mr. Elon Musk. What else is going on here? Risk off is still, it's top of mind. Some of these risk off sectors are still technically outperforming the S&Ps, utilities notably in that uptrend down below. Let's move into some specialized ratios. We got the XLK over the SHY. What do we see here? We've got the recapture of the breakdown point into the duration of the end of the week. That does strike me as constructive, and once again a step back towards risk on being the predominant fuel in the market. You're going to see similar things here in the this one no, because utilities are just on a rampage in the upward direction. But what you will see, right? So this is still a threat, but what you will see here, let's come on over to this one, SMH XLV, so semiconductors and healthcare, staying over that upward sloping 50 SMA looks more like a failed breakdown over here and constructive consolidation high in the top of the overall range. You'll notice that I skipped one, and that of course was the XLY XLP, continues to be lackluster inside of this overall range. So individual ratios are a little bit more of a mixed bag, but the actual structural charts, in my opinion, what technically matters is more so indicative of a bit more of a recovery and optimism on the horizon compared to, oh my goodness, run, duck, and cover, markets are going to go to zero. Let's move along to the dollar. What's going on over here? This obviously will be impacted by what happens with CPI, but notice that we have the possible threat of a lower high underneath the top end of the balance range here. If this can stick, if this moves in the downward direction, that of course would be bullish for equities down below. If this turns into a double bottom and we recapture the neckline, aka the top of the range, not this range, but the overall range, this really requires, I suppose, a monthly time frame chart. This range, there it is. If we recapture the top of that becomes much more concerning. Upward pressure in the dollar, of course, would imply downward pressure in equities, keeping an eye on that relationship this week, specifically around CPI. What's gold doing? We have not checked in gold recently, moving back in the upward direction. So in theory, that's going to continue to put downward pressure on the dollar. Is it more of a flight to safety though? I mean, it's still in that category. Remember that this massive outperformance, I don't want to say it was directly sort of a forecast for what came over here, but it certainly didn't align with, bullish activity based on the relationship with the dollar. We'll put it that way, right? Let's move along to the TNX and start talking about interest rates here as CPI becomes top of mind for our conversation. Pulling back, yes, but what do we see, right? Lows, higher lows, higher lows, higher lows. And the illustration that we made in the pre-market prep a couple of times this week was that even if we pulled all the way back into 4.33 is technically the 10-year rate, 43.33 in the TNX, this is clearly an opportunity for a higher low. If we rebounded off of that and made the equal high, that probably spells pain for the market over here. Now, we've been navigating it quite well in terms of this, sure, it caused the pullback, but the pullback out of rates themselves is pretty, I would call that respectful of, it was very quick, I suppose. It's not like we lingered up here, continued to drift in the upward direction. The breakdown was quite rapid underneath the bottom end of this consolidation. So we'll see if CPI comes in hot. I would expect this to go back up here. And the big watch out of the TNX is, do we break out over 4680? If CPI is hot and we break out over 4680, it probably spells another leg lower for your S&P 500. Is that a bet that I'm willing to take early? The answer is not really, but let's take a look at the Fed tracker tool and more of the fundamental data points. So we can see that there's not much change since the last time we checked into the tracker tool, but this week in particular, we really want to pay attention to where the first cut is being priced in here, because Jerome Powell's dilemma is either going to be highlighted or it's going to be resolved. As we know, on the Thursday session of last week, let's take a look at the calendar here, we got the unemployment claims, the initial weekly jobless claims, and this was the first major miss in the upward direction. We got 231,000 versus a 212,000 expectation. If we open up the chart here, notice again the orange is the expectation and the blue is the actual print. We're breaking out, if you will, of this as a range. I wouldn't go out on a limb and say that this means that the next monthly read of unemployment is going to be like 4%, but it's certainly something that Jerome Powell has to consider. Is the labor market starting to deteriorate? And if so, that goes directly back to his dual mandate: price stability and maximum employment. Which one is he going to favor? And once again, this week, as we get CPI, watch out for what the market is basically pricing in as which one is his priority. If you start to see that the rate cut is pushed up, it means that the market thinks that the labor market is more of a threat. If you see that the rate cut is being pushed out in time, that means that the market perceives that inflation is more of a threat. So let's go back on over to the calendar here. Let's take a look at what we have in the upcoming weeks worth of trade. As we know, it's loaded, right? So PPI comes out on the Tuesday session, producer price index, and then Powell speaks at 10 o'clock. That should be fairly interesting. However, Wednesday is where the fireworks go off with CPI and retail sales. Primarily, we want to pay attention to core CPI, month over month and annualized. As of right now, the expectations are for a 0.3. Previous was a 0.4. If we open up this chart and see the previous expectations, you'll notice that we had been expecting 0.3 for a very long time here, and 3 months in a row we've missed in the upward direction. That, of course, is going to put pressure on Jerome Powell to, again, start making a determination as to which is more important, price stability or the maximum employment side of the dual mandate. As we know, inflation has been sort of stagnating around that 3, maybe 3.5% mark, depending on which metric you use on an annualized basis. And that, of course, is not the Fed's target of 2%. Now, in the intro, I mentioned that there were two compelling arguments for either a hot or a cold read. If you take a look at the container index, the freight container index, this is basically how much it costs to ship something, right, in a major freight container. Let's also think back to what's been the driver recently of inflation rebounding in the upward direction. Services inflation has been pretty stagnant. It really hasn't contracted much more. The lag impacts have not caught up. Goods inflation resurging has actually caused inflation to sort of start ticking back in the upward direction. And what do you think is going on here with the freight index, right? What do you think, retailers are going to do with their increased shipping costs? They're going to pass that right through to you as the consumer. So goods inflation wouldn't really appear to be going anywhere anytime soon, and this is on the side of a hot inflation print for this Wednesday's session. The cool side of inflation comes from the services side and owners equivalent rent / Zillow rent indexes, right? If you look at what's going on here, the new leases signed has actually dramatically pulled back, both from Zillow as well as Apartment List as credible sources, and owners equivalent rent from the CPI has not really followed suit as aggressively. Notice the sort of lag between the peak and the peak over here. If we scroll down to another graph, let's take a look at this, you'll notice that the new tenant rent index is down dramatically, right? So typically it's pretty stable around 2%. Hey, that sounds like the Fed's target for inflation, right? This is underneath that target. So once again, is services inflation lagging? Is it about to catch up in a meaningful way? It's possible based on the services side, but this is just the argument on either side of the coin. Now, as you guys know, as a trader, I will be flat into CPI. I will not have a horse in the race, a dog in the fight. I will trade the aftermath of CPI. So take this information, use it for what you will, but personally, I again will be flat into the actual announcement. Let's take a look at the earnings calendar as we move into the upcoming week's worth of trade. Apologies for not having that loaded up, but here we go. We know that all the heavy hitters are mostly in the rearview mirror. Some interesting and honorable mentions here now are going to be something like your Home Depot, right? From a building perspective, not literally the XLB, but generally speaking, what's going on with the building space. I would be interested in Cisco as well on the Wednesday after the close, as well as Walmart and Applied Materials on the Thursday session. JD, well, actually DE is the ticker, but John Deere is also going to be an interesting setup. We talked about that on the Friday pre-market prep, but those are your honorable mentions. The big one that we have to look forward to, as we all know, is going to be NVIDIA. If you're interested in semiconductors, I would really pay attention to Applied Materials, the people who supply the stuff to make the chips in the first place. Let's dive into the risk appetite charts here, and I want to point out that these uptrends are still technically intact out of bonds in relationship to themselves. So as the market has made this advance back in the upward direction primarily over the duration of last week, it's correlated with a pullback out of these bond relationships. If these catch for higher lows at upward sloping 50 SMAs and move back in the upward direction, I would not be surprised in the slightest to see more of that pullback unfold in the market. So still thinking about 512.50, but to get there wouldn't be unreasonable. Again, if these tick higher, I would sort of make note to yourself and say, all right, maybe pay attention more so for the pullback in the equities market. If we take a look at credit spreads here, you'll also notice that these are fairly stable. So pullback fine if those bonds in relationship to themselves start to tick higher for a higher low, but end of the world credit event, absolutely not as of right now. These are pretty stable down below at the lows. Let's take a look at the HYG in isolation. What you'll notice over here is a little bit of a divergence, once again supporting the concept of a pullback in the market. Notice the lower high happening here with the higher high happening here in equities. We're still over a key inflection point out of the HYG at 76.60, so once again, pullback into 512.50 does not seem unreasonable based on the negative divergence happening here, but oh my goodness, markets are going to zero. Not quite if the HYG is over 76.60. Let's take a look at Bitcoin by itself. You'll notice that it's hanging out inside of the flag range still. I would be interested if this produced an inverted head and shoulders back to the top of the range. That's a possible trade. Might look into that in Bitcoin itself, but you got to build out that right shoulder first. If it does drift underneath that 69.70, that would be a little bit more concerning. Again, still a pullback after a very impressive run in the upward direction. This is not totally risk off just yet. Let's take a look at new highs versus lows specifically. Well, I guess the weekly chart is actually a great illustration, but look at this move off of the zero line in the upward direction. Once again, unlike the pullback from the sort of end of 2023, if you will, over here, where we actually did get a little bit more negative. Remember, there's this fake out above, then right back below. I mean, this is constructive in the upward direction. Breadth is improving as this market advance has been taking place, and that does stack up as more of a bullish data point. Here's the SPX A200R, just noting that it's trending higher, right? Over the last couple of weeks, it's been moving higher instead of stagnating inside of an overall range. I mean, technically speaking, you could consider this a range, and it's just kind of in that range, but it's not like it's just completely flat like it was in this segment of the chart. SPX A50R, stocks trading over the 50 SMA, did recapture the 50% mark. So once again, constructive in terms of breadth making a move in the upward direction with the market and its advance as well. Here is the RSP equal weight S&P 500 breaking out over this high, pull back higher, low above, and moving in the upward direction. It's not quite as close to the all-time high, or at least pivot high, in the RSP compared to the weighted down below, but still steps in the right direction. We're at least in an uptrend. We're not divergent here out of the RSP. Can't quite say the same for the QQQE. You have not recaptured still your weekly inflection point out of the equal weight NASDAQ. This is a small red flag that I am carrying forward here out of this market. Let's move along to our volatility indications via the VIX, continuing to drift in the downward direction. Lower volatility means an environment is easier to move in the upward direction. Let's take a look at the VVIX, absolutely floored underneath 75. This is the lowest read we've seen in a very, very long time. I would start to be thinking about the complacency effect. Once again, this being so low leads me to believe that if everybody's just sort of like willy-nilly, oh my God, the markets can only go higher, that's sort of the recipe for, okay, let's deliver a pullback, right? So I'd be on the lookout for that. It doesn't mean, we're not positioning short in hopes of a pullback, but it wouldn't be a shocker if this comes off the lows for some sort of move off of the bottom. Let's take a look at volatility via the futures. Really deep contangos here. So again, this is healthy for the market environment, One-day VIX is back down at the floor around 745, so all good out of volatility. I would primarily say that a pullback can unfold in the S&P based on the supporting evidence here, but we're not looking for like a huge follow through underneath 512.50 with the caveat, here is your massive asterisk, right? With the caveat that CPI sort of will overpower any of these technical indications. If you've made it to this point in today's analysis, I'm sure you're enjoying the episode. Hit the subscribe button, not only so you don't miss future updates, but more importantly, let's get to 100K by May so we can release some merch. How about that, right? Not if, but when we get there, let's put out some merch. What do you guys want to see? T-shirts, hooded sweatshirts? Do you guys want to see mugs, water bottles, something along those lines? Let's be really on the nose. We could do embroidered vests. I don't know. Let me know down below in the comments section, and we can make it happen for 100K whenever it happens. And don't get it twisted. We're not going to include anything related to YouTube on the merchandise. It's just going to be the milestone that kicks it off. We'll make something really tastefully done, right? So with that said, we'll kick off the core list with Apple here. What do we see out of Apple? On the zoomed out daily chart, I do want to acknowledge the progress made in the upward direction, holding over a mostly flattened out at this point 200 SMA on the daily time frame chart. That's the green moving average on your screen. However, we haven't fully resolved this level here at 182.65, which is the low of the gap up candle. So on the hourly time frame chart, if we take a closer look here, notice that on Thursday, there was a pretty compelling break back in the upward direction inside of the earnings range. However, on Friday, there wasn't much of an offering for like a clear, higher low being offered at 182.65. I mean, we just sort of chopped around that level into the close of the week and the close of the session. So early on this upcoming week, I'd prefer to see some sort of like opening drive, first 5-minute higher low pullback, trades into the high of Friday, then the top of the range. That would be interesting because this is a thin structure retracement. If we're underneath 182.65 because of Thursday's rally, I would dial back the short expectations and only really be thinking about the next major short if we break down underneath the swing low basically here at 180.50. Now, the full gap close is not the target. 177 is the target coming from the top of the daily previous range from back over here. Let's move along to Microsoft. Microsoft has resolved that 400 figure in the upward direction. If this is going to be construed as a very sloppy but there double bottom, heck, even just call it a balance range like this, we're attempting to break it in the upward direction. We're trying to get the clearance of this level here at 413.25. In the case that that happens, your first target has to be the bottom of this overhead range here at 419.25. Beyond that, I would start thinking about like 428.75. You guys know the rules up here in the penthouse, round numbers only, so we're going to make that a 75. And let's take it on down to the hourly time frame chart here and just take a closer look. So to play this into the upcoming week, I would prefer to see like balance and then breakouts over Friday's high. That's interesting into 419.25. If we look into the 413.25, not in love with that, but the constructive trade would be, okay, this consolidates, it stays here. The first higher low back above 413.25 is rock and roll back in the upward direction. The time to be short Microsoft is really exhibiting some patience and waiting for a breakdown underneath this level, in my opinion, looking for a thinner structure retracement into that 400 key daily area. Let's take it on over to Google and see what's going on with the daily time frame chart first. You'll notice that we are holding the earnings gap up. It did not close all the way. And as of right now, we're attempting to get back into the earnings gap up range range, this individual bar up here. So the watch would be, let's take it on down to the hourly now that we understand that context. And by the way, this is the all-time high, right? So the watch would be any consolidation over these highs, which looks like this is a very mild pullback above the top of this range, right, at 167.50. If this can hold, higher lows here are constructive and looking for a move into 174.50. If it's just chopping around in here, very similar to Microsoft, I would have to encourage patience. This is not the time for, in my opinion, an aggressive short, and instead I would just be looking for this. If you're trying to play this short, you really want to be aiming at, again, in my humble opinion, some sort of risk reward that does this, back down into the swing highs, and potentially, if you can hold on to some runners, that would balloon it into something more so like a 5-to-1 risk reward. So shorts, be patient, not really seeing the cleaner setup structurally here and trying to favor more so those long ideas on the mild pullbacks, being respectful of the top of the balance range in here. That is Google. Let's move along to Nancy. What's going on with Amazon daily time frame chart? This is, I would call it a very lackluster chart. And the reasoning for that is that we know this is an all-time high. We've tested that all-time high a number of times here, and we just really have failed to get follow through in the upward direction. It seems as though nobody's excited for the blue sky breakout in Amazon. So understanding that, if you're looking for shorts, this is possibly a place to do it instead of something like your Microsoft, Google, right? I would be looking for a possible head and shoulders out of Amazon. Here you go. There's your head and shoulders breakdown under the neckline. That's currently at 187.25. Maybe it starts to trade in the downward direction. So I would just take it step by step. Downside target first 184.75, then maybe down here at 182.75. We know that in this range, really want to stay away from Amazon. Very, very choppy and really lacked clarity and any sort of trend in that box. So if we were to get down here and offer some sort of reversal back in the upward direction, maybe it's a daily high or low, but again, one step at a time out of Amazon. It doesn't seem like people are thrilled about new money longs at the all-time high. NVIDIA is up next. Remember, earnings are a little bit further out on this one, so not a concern just yet, but it is on the horizon. What do we see here? So if this is a daily look below and fail, top of the range has been achieved. That was the Monday session, and now we just got continued balance into the end of the week. So what's the name of the game? Looking for a higher low, looking for the trend to continue. We have lows, higher lows, higher lows. Could these be higher lows based on Thursday's pullback? It seems like the answer is yes. So understanding that context on the daily, any consolidation in here is bullish. Continued breaks over 922, basically aiming at the all-time high. Let's get granular on the hourly as we take a look over here. If this is a double bottom, you want to stay over that neckline at 895. Consolidation in here is bullish, looking for the top of the range 922, and then follow through based on the daily pattern we just described like this. If the sellers are going to make something happen, I would not be short back down underneath 895, and instead I would wait for the breakdown here and the loss of the retest of previous resistance, which is now acting as support. Underneath 880, the gap close would be your target around 860. Moving along to AMD. AMD has been a little bit of a hit or miss in terms of how it's been trading recently. I don't like the fact that it's still underneath the neckline of a massive daily head and shoulders, something that looks like this. We're really just chopping around in this range. So I'd be inclined to have a little bit more of a bearish bias because of that. If we knock it on down to the hourly time frame chart, I mean, it's hard to ignore that this was a meaningful advance and the pullback is mild so far, but you still got highs, lower highs, lower highs. I'd be mostly interested in AMD. Breakdowns underneath what's starting to emerge as a flush point here at 151, trading back down into 148.15, and then possibly these lows at 143.75. I'm not really seeing any clear long opportunities. It's really got to change that daily chart before I'm more thrilled about looking for longs here. Let's move along to Metaverse. What's going on with Zuckerberg's Fantasyland just continues to close the gap overhead. Status quo. The march continues in the upward direction. If we take a look at the hourly chart, very, very clear flat top breakout point here at 476. If we can clear that, the gap closes at 484.60, and then beyond that, it's really a thin structure retracement into the opening print of that larger red-bodied bar the day before earnings. Let's adjust that. Let's go 35. It's not technically a quarter, but we can do with nickels up here in the penthouse. So that is your thin structure retracement. To the downside, I would only be looking for shorts out of Meta on a lower high underneath 463, trading back down into the top of the range here, 443.25. When and if we get there, daily high or low has to be top of mind. Daily high or low. Very impressive move through the gap. Thinking about buyers stepping up on the retest of the breakout point over here. Next up, Tesla. Tesla, like AMD, has been a lackluster trader recently. Just very choppy through here, day up, day down. The trend is starting to resolve back to the downside with lower highs as well as lower lows. You are technically inside of this previous balance range here, but breaking down through this, I think it becomes quite clear that this is the idea, right? Looking for that continuation back down to the bottom end of the range. This could be considered a very classic look above and fail. Target's always the bottom, 160, 125. Here it is on the hourly time frame chart. You will notice that you have a bear flag, like weak on the lows consolidation all day on the Friday session. So your Stevie Wonder trade is in order for the Monday session. If we open over the top of this consolidation, let's call that 169.25. Again, round numbers only up here. We'll go 25 on that. If you open over the level, you're looking for a quick snappy move into 170, 175. If you want to take the trade, the Stevie Wonder means that you're basically managing your risk via total dollars in the position. So if that means taking one contract, it means taking one. If it means taking 10 contracts, it means taking 10. If it means 100, whatever is proper for your account size, that is how that trade is managed. And when we get here thinking about the lower high reversal based on the daily analysis that we just conducted, if we open in the range, obviously it's a bear flag, and any continuation under Friday's low, you're looking for that move into 160, 125. Next up, Netflix. What's going on with Netflix? This thing has been on a rampage. It's finally starting to cool off. So the interesting thing about the cool off here is that we didn't go gap fill reversal. We went recapture the entire gap, close inside of the previous overhead supply, and now start to support over the daily 50 SMA over the previous lows. So any consolidation here, how could you not call it anything other than a bull flag recapture looking for a move in the upward direction? Here it is on the hourly time frame. A little bit of a sharper reversal on that Friday morning session. However, holding these lows quite nicely. Any consolidation is neutral, at least intraday in terms of operation, and then bullish on any breaks over 618, 631 is the next target. If you slip this, it's sort of more so like your metaverse. I think you could retrace some of this thin structure, obviously, but I would be thinking about where's the higher low over the top of the previous earnings range, which is down here at 579. So those are possible ideas out of Netflix. It's been a tough one if you don't have the faith and confidence to just go long and hold it or go short and hold it. It's one of these things that it's not offering very clear structure. It's just like go, whatever direction happens to emerge on the day. So for that reason, we've been throwing in JP Morgan into the core list of companies. Great move out of JP Morgan breaking out over the top of this as a flag range from the weekly. It's also a trend line break. So this is still the hourly time frame chart, but you get the idea on a daily chart, right? You could see that this was a downtrend line. This was coming into it off of a higher low, broke, and basically went to the equal high via the gap up on the Friday session. We know that as a sector, financials have been performing quite well, so I'm loving the setup here. As we move into the upcoming week, Friday is obviously lackluster, just kind of neutral after the gap up. So a couple of things emerge. Either a gap fill reversal on the downside is long back into this high at $200.75, or if you slip the full gap close and lower high underneath 197.55, lower high offers the possibility of a retracement here into 194. When and if we were to get here, that's where you're thinking about the next higher low. So lows, higher lows, daily higher lows, right? So that is JP Morgan, and that concludes the core list of companies. Let's move directly into the two trade ideas. First up is on Coinbase, of course, is what we're looking for. And the idea here, let's go to a daily chart. There we go. Is that we can look for a move to the downside after failing this overhead supply, with Bitcoin threatening possibly, I know I was talking about the inverted head and shoulders, but if Bitcoin breaks down from that range, I think that Coinbase, obviously suffers, sort of similar fate by moving to the downside here. So continued consolidation underneath the line in the sand at 213 is bearish, keeping the overhead supply, and breakdowns through the equal lows get interesting under 199.15 into 186.75. If you actually apply the volume profile to this particular chart, and let's zoom out on this here, you'll notice that this is a high, like rightfully so. Let's get a little bit more nuanced here. Let's go to, let's see, what do we want? Let's go like something that's going to be a little bit easier to visualize. Let's go with a 6-month chart perhaps. Yeah, there we go. So notice that this is the shelf, right? See this little shelf right here? That is the breakdown of 213. So all of this is weighing on us first and foremost. And if we slip this next shelf, doing something like this, what does that imply? Low volume void, what's the retest? Very, very clear back to this previous pivot high and the top there at 186.75. So Coinbase could just be like a single day scalp to the downside to get there. That's interesting to me. This is sort of like a next high volume node down below where this little consolidation took place. So generally just looking for shorts in Coinbase if this can stay underneath the 213 level. If it's over 213, I would sort of, be a little bit more neutral on it and really look to Bitcoin itself to guide that particular trade. Let's go back to a more reasonable looking chart here, and we will bring up Walmart as our final idea for this week's weekend edition of the weekly watch list. What do we see? Break of the resistance trend line from here, consolidation over, you could start to make an argument that this is like a loose area of support, but if you can break these highs, that to me is bullish. And what else did we see outperform quite well last week? XLP consumer staples Walmart falls into that category, right? So if we're thinking about consolidation, breaks and higher lows here, that to me is interesting. The range is not great. The range is certainly not great out of Walmart. So, you could trade this with shares. You'd be fine there. Earnings are later on in the week. We saw that on the calendar. You could lever up with some options here. Just be mindful that the range isn't really that large. So for that reason, it's not like a top watch, but it's definitely a trade idea worth considering, noting the posture of the sectors over here. That's going to do it for today's episode of the weekly watch list. You can see again that consolidation over here over that 50 SMA pinching. That's the trade idea. But that's going to do it for today's episode. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. And we will see you all bright and early on the Monday morning session for the pre-market prep up in the Penthouse Studios at 8 o'clock. 8 o'clock is the new kickoff time. Hope to see you there. And with that said, I wish you a green trading week.